your retirement income plan. Plus, there's another question that we've got for investors that they should be asking in today's world, and pretty much at any point in time they should be asking this particular question, but certainly now more than ever. Welcome to Dollars and Cents, where we help you make sense out of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you every Sunday morning at 9 on the News Radio WFLA Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 10,000 downloads of our episodes. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So before we get to all of those other topics, if you're a regular listener to the program, you know that we regularly spend time on the program debunking some of the more popular trends in the financial industry, whether it's the latest annuity or tax-free trick involving an insurance product or something like that. We certainly talk a lot about it, but every now and then, surprisingly, the industry actually comes up with a proposal that we can certainly get behind because it just makes sense. And we wanted to share with you that latest proposal that's circulating around in the financial industry and its impact on you. Let's set the table a little bit first. One of the biggest, most troubling trends in the industry is that when people change their job, and the reality is that always peaks during tough economic periods of time, that there's a tendency for folks to just cash out their 401k or 403b or whatever it is that they had with their old employer. When they leave, they sort of, it's not worth the effort, it's not worth the bother, I'm just going to go ahead and cash it out, send me a check, and that's that. The reality is that happens about 30% of the time. So it's a significant occurrence. What's even more troubling when you start to kind of peel back the statistics on this cash out of retirement plans when people leave their employer is that it's estimated as much as 80% of those leaving jobs with balances less than $5,000. So in essence, a smaller balance is far more likely to get cashed out. Leave the employer, send me a check, don't bother to do anything else. It's just a small balance, not going to worry about it. The problem with that is that traditionally affects minorities, it traditionally affects younger workers, it traditionally affects low-wage earners disproportionately, because those groups of folks are generally the ones that have the smaller balances. So it does a much greater harm to those people that ultimately need to be planning and saving for retirement more than the person that's got, gobs of money, if you will. Ultimately, that cash out really does threaten retirement and the simple notion of accumulating wealth over time, right? So under current law, the problem is the current law. Under current law, employers can choose to simply cash out your balance and mail you a check if it's less than $1,000. That obviously creates taxes, it creates penalties, and ultimately, great, I got a check for $1,000, but I just had to give 35% of it to the government. That's not a very good deal. Obviously, that impacts your retirement and your taxes as well. If your balance is between $1,000 and $5,000 under current law, employers typically have an option as to just sort of leave it alone, or traditionally what they do is they roll it over to an IRA with the custodian of the 401k plan. And the reason they do that is that when you have a 401k, there's a lot of testing that you have to do, a lot of math that you have to do to make sure that the plan is a plan that satisfies Department of Labor regulations. And so consequently, there is a reason why employers probably want to push those smaller balances off, because it makes the average balance of the plan go up. If you can push those smaller ones off, so those smaller balance accounts off, especially if it's an ex-employee. So unfortunately, though, what typically happens when those balances get transferred over to an IRA is that because, again, of the rules, Department of Labor rules, traditionally that money then just gets dropped into like a money market or a CD or a savings type of an account where there's not really much of a return. So if you're cashing out, I mean, those early distributions for those smaller balances may ultimately not seem like that much, but it threatens, there's estimates that say that it could potentially reduce the wealth in U.S. retirement accounts by about 25% over the course of the next 30 years. A little bit of money among a lot of people adds up. And when you're looking at the potential impact being 25% less in U.S. retirement accounts over the course of the next 30 years, that's not an insignificant thing. So what's the proposal that has been suggested to try and improve this? Well, it's this notion to provide for automatic transfers of those smaller employer plan accounts when an employee leaves, to provide for an automatic transfer over to the new employer retirement plan. So I leave my employer, they've got a 401k, it's got a $3,000 balance in it. I go to work for another employer, they've got a 401k, and the process would be whereby my old 401k balance would automatically transfer into my new 401k balance. And we think that is a very good idea in order to stop this cashing out that we see occurring on a regular basis, particularly among the small accounts, which disproportionately affect lower income minorities, young earners. That has got to stop in order to make sure that their retirement is in as good a shape as it possibly can be. So here's how it would work. Obviously, you can opt out of it as you can with anything. It involves some data sharing between plan providers and record keepers to find out the departing employee's new plan, and then to be able to facilitate the transfer. The more record keepers, and those are the folks that kind of keep the records behind any employer retirement plan, and then participants, those are the ones that sort of provide, or providers, those are the ones that provide sort of the structure of the plan. The more you get record keepers and providers to participate, then the more this will in fact become a reality. And that estimate that if we can reduce those automatic cash outs that occur, participants will wind up with over $1.5 trillion cumulatively over the next 40 years. That's big, that's significant, and certainly an important provision or proposal by the financial services industry that I think everybody can get behind, particularly on the automatic transfer of old 401k balances to new 401k plans for all employees. A great idea, one that we don't hear very often these days, but certainly one that we would encourage folks to really get behind. We'll take a break. When we get back, we're going to ask the question, what's the most important question that an investor can be asking today? All that and more when we return on Dollars and Cents. What's in a name? That's a very famous quote from William Shakespeare's Romeo and Juliet. We think it applies to the question that investors should be asking today. Welcome back to Dollars and Cents. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this coming week to help you change your life with a successful plan that provides you with peace of mind for the future. There's so many terms out there in the industry, and the industry's done a great job at creating a lot of confusion with the various terms that they have out there. So you can go visit somebody that might be called a financial planner, a financial advisor, an investment advisor, a stockbroker. I mean, the list goes on and on. There's no shortage of names that are floating around out there in the financial industry. And then on the flip side, there's also now a lot of labels in terms of how the compensation is paid to that particular person, whether is it fee only, is it fee based, is it commission, is it a blend, is it an hourly fee? I mean, there's so many different options out there. And somewhere along the line, the notion of one over the other, fee over commission, or fee hourly over fee over, at the end of the day, a cost is still a cost. The question is not what's in a name, it's what's really happening underneath the hood. It doesn't matter whether someone is calling themselves a financial planner or a fiduciary or whatever they are calling themselves. And by the way, they should certainly at a minimum have those types of credentials, whether they be certified financial planner or certified financial fiduciary, whatever the case may be. I mean, as a baseline, if you're dealing with anybody in this industry, you would want them to at least have those types of credentials. But there's more to the story. There's more to what investors really need to know, and what particularly they should be asking today. The most popular question I'm getting right now is, who's going to win the election? Or what's going to happen if person A wins the election? What's going to happen if Trump wins the election? What's going to happen if Biden wins the election? And those are certainly important questions, and believe me, we'll certainly have some shows on those in the future, particularly as we get closer to the election. But we think that there is another question that strips away all of these labels and all of these terms and all of these titles and boils it down to one simple question: whether you're a fiduciary or not, whether you're doing things in the best interest or not, the bottom line question is, how much is this costing me? If I tell you something is low fat but it causes cancer, you're probably not going to want to participate. Here's the dirty little secret that the financial services industry knows all too well. And you really need to listen to this part, because the industry knows very well that the vast majority of the investing public has no idea what's on their statements. No idea at all the information that's on their statements. Nobody reads it, nobody understands it. The statement is 15 pages long, 25 pages long. Shoot, we've seen some statements that folks have brought into us that have been 30 pages long. Okay? How are you ever going to figure out what is exactly going on? So our point is, don't get too hung up on the label or what somebody is or isn't doing or how they're describing themselves or any of those kinds of factors. The bottom line that every investor should know is, how much is it costing me? Because let's face it, during tough times like this, the bottom line is, if you keep your expenses down, if you keep your costs down, well, then you keep more of the return. That's always kind of how it works. But particularly during tough economic times, those are the times when you really want to be particularly concerned, now more than ever, as to what the bottom line is. So let's just put some numbers on this for just a second, okay? Because the cost typically for investors is buried in page 18 of the 20-page statement, and as we said, the industry sort of knows nobody ever looks at this stuff, so we bury it. We slice and dice, we put different words out there, we put different terms out there, and at the end of the day, it just creates confusion, and investors miss what ultimately is their bottom line cost. So let's say you've got $500,000. You have a $500,000 account, you want to use an advisor. Certainly a lot of folks running around out there running ads that say they won't talk to you unless you have $500,000. That's a different topic for a different show. Candidly, I think the notion of discriminating against somebody because they don't have $500,000 says a lot about the kind of operation that is being run. Folks with less than $500,000 probably need more assistance and guidance than those that have more than $500,000. But we don't want to deal with the people that may actually need some guidance, that may actually need some real help. We just want to deal with the people that are easier to deal with. That's the message when you hear that. And we philosophically disagree with it. That's why our firm has never had a minimum, nor will we ever have a minimum for you to come in and visit with us. I digress. Let's put some numbers on it. So I've got a $500,000 account. Let's say you're being charged 1.5%. You say, oh my goodness, Joel, that sounds like a lot. Is anybody actually being charged that? And the answer is, yeah, a lot of people are getting charged that kind of a fee on an annual basis. 1.5% of $500,000 is $7,500. 1% of $500,000 is $5,000. That's $2,500 difference that goes in your pocket rather than the financial services company's pocket of which you are dealing with. That's about $200 a month. That is significant. Even going from 1.25 down to 1%, that's a $1,250 savings on a $500,000 account. That is big. Now, take a minute and imagine even bigger numbers. What if you had a $2 million account? Maybe you weren't having to pay 1.5%, but maybe on those you were paying 1.25% or maybe even 1% on that. What if you could have that portfolio only be costing you 0.25% and still be able to have some active management and be able to speak to a financial person on in person or on a phone or on a Zoom call or whatever the case may be in today's world? Well, that's a huge difference. Now you go from paying $20,000 a year, and believe me, there are many people out there who do that and don't know it, down to potentially $5,000. Run the numbers. Folks, that's the question to really ask. It's not what's your title, what's your credentials. That's kind of a baseline question, frankly. It's not how are you paid. It's not how you do business. It's not where you're located. It's not any of those things. If you really want to get down to the brass tacks of it, to the bottom line, it doesn't matter whether someone calls themselves a planner, an advisor, or a lemon wedge. It's how they ultimately move that cost over to you. Fee only, fee-based, wampum-based, it doesn't matter. It's all nonsense. The bottom line question is, if you really want to know whether someone has your best interests at heart, ask them the number. Ask them how much. How much does that translate in terms of dollar numbers? And frankly, if you hear a number greater than 1%, you probably want to look elsewhere because there's better options than that. I'm sure that segment disturbed the industry, a lot of folks in the industry a lot. Doesn't matter. What I've just said is 100% accurate. So check it out. That's the question that investors need to be asking. What am I paying on my account? We'll come back after these messages here on Dollars and Cents, coming up next. So do you have a retirement income plan? I mean, that's something that you want to do certainly before retirement, not after. Welcome back to Dollars and Cents, where we help you make sense out of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So, what exactly is a retirement income plan? You don't hear much about that, but it's probably the single most important step in that transition from working to retiring, from accumulating wealth over time as you're working to now spending it over time as you retire. And it sort of starts first off with sort of an understanding of the overall picture. What you own and what you owe is the simplest way to describe it. And so what you own, obviously, those would be your assets, your house, your investment accounts, your 401k, your IRAs, your savings, your money market, all of those types of things. And then what you owe is things like your mortgage, or student loans. Hopefully you don't have any of those entering into retirement. Your credit card debt, another one. Hopefully you don't have any of that heading into retirement. But that's kind of the getting that overall picture. And then particularly on the what you owe, you want to sort of divide that up into long-term stuff versus short-term stuff. Long-term stuff would be a mortgage. Short-term stuff would be a car loan. So once you've sort of done that exercise of sort of getting that overall picture of what you own versus what you owe, then you want to further divide the what you own part up by the tax nature and the liquidity. So tax nature, what do you mean? What do we mean by that? Is it an after-tax asset or is it a pre-tax asset? Pre-tax asset means that it's going to be taxed, most likely fully, when you take it out and spend it during the course of your retirement. So pre-tax assets would be traditionally like an IRA, 401k, 403b, deferred comp, those types of accounts. After tax would be a joint account or an account in your individual name that is outside of those retirement wrappers, if you will. So that's the tax nature part. The liquidity part is a different piece of the equation, because liquidity is important because when you're retired and you're getting income, then you need to make sure that it's set up in such a way as the income comes out and comes to you on a normal monthly basis, because after all, that's what you need for income in order to make sure that you can stay retired. So a house, for example, even though that's a part of what you own, that's part of your asset picture, isn't really liquid. A rental property isn't really liquid. The only income you're getting from that is the net amount of what that rental would be after you pay the expenses. So you really kind of have to look at things. Is it liquid? Is it not? Is it generating out cash flow or not? Certain investments, house being an easy example, but there's plenty of real estate limited partnerships and things like that. Annuities, another one where you've got some cost considerations and some liquidity considerations that make it difficult to generate out income on a regular basis. So once you've done that, then you've got to dig deeper on the tax nature of kind of what those assets look like. The reality is that on a taxable account, that should generally be where you have more of your bond side sitting, because bonds generate interest. That interest is taxed at ordinary income. If you're taking money out of a retirement account, then that too is also taxed as ordinary income. If you've got after-tax assets, that's where you would want to have things more like dividends and the like, because dividends and assets that generate capital gains are actually taxed at a lesser rate. So it's fine to have that inside of an IRA, but if you could plan it ideally you'd certainly want that outside of the IRA in order to take advantage of the lower taxes that exist on dividends and capital gains. So the other part to understand on the after-tax side of things is what's the basis of those assets. And when we talk about basis, we're talking about the money that you have put in along the way. So let's say you bought a stock and you put $5,000 in. That becomes the basis, so that if the stock is $10,000 and you say, okay, I want to sell that stock, then you don't have to report gain on the full $10,000. You can reduce that $10,000 by your basis, which is $5,000. So then you'd only have a gain of $5,000 to report. Long-term capital gains, max tax rate for the vast majority of people, about 15%. So that's a much better approach, much more tax efficient than simply taking out of a retirement account and having to pay a higher level of income tax on it. So that kind of starts to set the table, if you will, in terms of kind of how you start this process of retirement income planning. It's important to understand what you own, what you owe. In terms of what you owe, is it short-term or long-term debt? In terms of what you own, is it pre-tax? Is it post-tax? Because then once you've gone through all of that division process, then you've got to start layering in those tax implications with the accounts that you have in order to determine what ultimately you're going to want to grab income from and how to plan on your taxes. Because the reality is that Social Security, for most people, and even more every year, continues to be taxable as your income goes above certain levels. And those levels now, because they haven't changed those levels in 40 years, more and more people are being picked up with their Social Security being included as income on their tax return and having to pay taxes on it. So Social Security, generally that is going to generate out a taxable amount of income. A pension or distribution of an IRA, that's going to generate out regular ordinary income, versus pulling from something that's paying a dividend or selling things that have a cost basis, that those items generate out capital gains. Those are in fact taxed at a much lower bracket. So the point of developing that retirement income plan is not just to look for the most tax efficient way to generate out that income in retirement, but also understand that it dovetails very well into what ultimately your investment allocation should look like, depending upon the type of account that you're talking about. And that ultimately is how you start to construct the retirement income plan in the most tax efficient and most consistent way possible. Because one of the things about retirement income is that you don't want that to be $1,000 one month and then $200 the next month and then $1,500 the next month. That becomes very difficult to plan. In retirement, you're looking for kind of a stable revenue of income that's going to come in, much like your paycheck was, and you want that to be consistent from one month to the next. So that's why it's so important to kind of develop that retirement income plan and know where the flexibility is in your overall financial picture. In retirement, you're going to have to be concerned with two major expenses that oftentimes people don't think about while they're working, and that is taxes and health insurance. When you're working, your employer withholds the taxes, you don't see it, so it's not like it's there. The reality is when you are retired, you have to plan for that piece because you have to deal with that, with tax withholding on that income and on those distributions that you're getting out. Similarly, on health insurance, employer kind of takes care of that. In retirement, you've got to make sure that you're putting that in as well. So some important things to think about if you are at or approaching retirement. Make sure you've got a retirement income plan in place before you retire. We'll continue the program after these messages here on Dollars and Cents. This is Joel Garris on News Radio WFLA 96.9 The Game. So just how big could the Federal Reserve balance sheet get in light of this COVID pandemic? And what's that all mean to all of us? Welcome back to Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Here on the program, we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, also happened to be one of the top 25 financial planning podcasts on the World Wide Web, with over 10,000 downloads of our podcast over the years. So that's an exciting threshold that we hit earlier this year, and certainly glad you've joined us on the program here on News Radio WFLA 96.9 The Game. So what's that mean anyway? The Federal Reserve balance sheet. We hear a lot about that. And so what does all of that mean when we say that the Federal Reserve of this great country of ours has a balance sheet and they're doing something with it? Well, first of all, understand, of course, what a balance sheet is. A balance sheet, like whether it's a business or a person, represents simply the assets that they have along with the liabilities. So it reflects the amount of the assets that the Federal Reserve itself as an institution owns. That's what, when we say Federal Reserve balance sheet, it's similar to saying, here's what the Federal Reserve owns. Balance sheet makes it sound, a little bit more technical. Then the question is, what assets does the Federal Reserve in fact own? Well, traditionally they would own U.S. Treasuries. That is traditionally what they would own. But now, unlike in 2008 even, the Federal Reserve could own corporate bonds, it could own municipal bonds, it could even own loans that it made to medium-sized businesses. And understand, when you hear all of those options that the Federal Reserve can now own, that's a much broader scope than 2008. And so what are we talking about in terms of numbers here? So in mid-March, the balance sheet, the amount of assets that the Federal Reserve owned, which at that point in time was pretty much exclusively United States Treasuries, was about $3 trillion. Today, that number is $7 trillion. So it's like doubled in the space of like 4 months. It's widely expected that that could actually top about 10 trillion. Those numbers are not just double from where they were a few months ago, but they're twice as much as what the Federal Reserve had on its balance sheet during the course of the 2008-2009 financial crisis. So just by way of comparison, the answer is it's a whole lot more on the Federal Reserve balance sheet than ever before. So how does that kind of ripple through? Like what's going on there? So what's happening there is the Federal Reserve buys an asset in exchange for cash. When it buys a treasury, it exchanges cash for that. That cash typically ends up in banks. It creates bank reserves. Okay, I sold a treasury, the Federal Reserve bought it, I got cash for that. So what the Federal Reserve is doing is they're putting a lot of cash into the banking system. We've talked about this before. The analogy we always like to use is that when there's a lot of cash in the economic and financial system, it's kind of like putting extra oil in the engine to make sure that the engine doesn't seize up. That really goes more towards effectively making sure that that engine works. So it's more like oil. It's not like gas. Gas, in the analogy, would be consumer spending and manufacturing. That would be gas. The higher consumer spending you have, the more gas is in the engine, the faster the engine goes, if you will. Not a perfect analogy on that. I'm not a perfect car guy, but you get the point. So what the Federal Reserve is doing is basically putting some oil in the engine, because when it buys an asset in exchange, it gives cash for that. Takes the asset, gives cash, cash winds up in the banking system. So when the smoke clears, the private sector ultimately owns fewer treasuries and more bank deposits of cash. Meanwhile, the Federal Reserve owns more treasuries. That's the exchange. So what's the implications of all of that now that we've set the stage for it? Well, basically winds up to three different things, right? So number one, should come as no surprise that the amount of bank deposits increases sharply when this is happening. And that's certainly what has happened and will continue to happen as the Federal Reserve continues to engage in those types of things that are more of these asset purchases that it engages in. In fact, right now, in comparison to where we were a few months ago, there's basically been a doubling of bank reserves, similar to what's happened on the Federal Reserve balance sheet. If the Federal Reserve balance sheet has doubled, that just didn't disappear or get created out of thin air. The corresponding side of the equation is the doubling of the bank reserves during that period of time. So that's the first implication of it. Number two, the private sector now owns more cash than before. It's a popular misbelief that sort of the Fed is doing is it's sort of causing things to disappear, and that's not at all. These are exchanges. When the Federal Reserve buys a treasury, it gives cash for it. The private sector then winds up holding more cash. So we've got a much higher level of bank deposits. We've got a private sector with more cash. Here's the bottom line. The third implication, probably the biggest part of it, is that because of that increase in cash, then that has sort of been forced on all of us by the Fed, the private sector will then start to look for other ways to use that cash rather than just by banking it. And that's the stimulative impact of what the Federal Reserve is doing when it does things like quantitative easing, when it decides to go into the market and buy treasuries in exchange for cash. It's putting cash in the system, and ultimately, when folks have a high level of cash, they start to think about, okay, well, what can I do with this? And if I keep it in the bank, it's not making anything, because the real kicker here is that starting back in October of 2008, the Federal Reserve can now control that rate much more than it used to be able to. So what the Federal Reserve can do is it can adjust the rate, sort of make people say, well, my cash isn't making anything, I might as well do something with it. And ultimately, that creates some economic activity. That's exactly sort of the expected stimulative impact of what the Fed is doing, trying to get that cash more to work. So the real question is that going to prove inflationary? That's obviously a concern. You hear a lot about it. But again, the kicker on that is that the Federal Reserve has the ability to adjust the interest rate, which it didn't have prior to October of 2008. So if there was a big jump in lending, namely, cash getting used, the Fed could always raise interest rates or lending rates to help dampen that down. So because the Federal Reserve sort of has that power, the dual power of being able to buy assets, but yet also at the same time to be able to control interest rates, that's where we get the situation that we get, which in theory should not be as inflationary as a lot of people believe. Certainly, we'll see how that plays out over the course of the months ahead, but we wanted to at least set the stage for exactly what is happening when we talk about the Federal Reserve increasing its balance sheet. We're going to wrap it on up and get on out of here. Thank you so much for listening to the program. If we can be of assistance during the course of the week, don't hesitate to give our office at Nelson Financial Planning a call, where our team of certified financial fiduciaries can help you this week with a successful financial plan that provides you with peace of mind for the future. Thanks for listening in.